very much for joining us at the end of your day. It's 5:30 on the East Coast. I know that there were some folks that thought that they might join from other time zones, so thank you for that as well. I am going to make sure, yes, we can advance the slides. Excellent. So here we are today, and we're going to talk about why and how to become a ready home buyer. So I am Patty Sutherland, and I am your host. I'm a broker associate with Sutherland Realty Group, which is affiliated with Keller Williams Realty, Boston Northwest, and Concord. I'm here with my special guest, David Brennan. We're actually neighbors. We live in the same neighborhood, which is kind of fun. And he is a home mortgage consultant and a new construction specialist with Wells Fargo. So if you don't have any questions to start with, let's just get going. So the agenda for today is why now is really a great time to consider purchasing a home. So I'll go through, kind of a lot of detail there, because it really, if you are renting, I think, and you've got the money to pay rent, you potentially have the money for a down payment to buy. So we'll talk about the rent versus buy decision. I'll also give you a heads up on the kinds of things that you would want to budget for. Because once you own that home, it's not just the mortgage payment that you need to be concerned about. You actually do have to maintain that home. And sometimes that needs a budget. Then David's going to talk about how we will qualify. Wells Fargo qualifies their clients for a mortgage. He'll talk a little bit about credit and the home financing basics, things to be aware of, and the home financing process itself. So why is now a really good time to buy? Now, what I'm going to share with you is my first home I purchased with my mother back in the 1980s. And she had money and I had a job, but neither one of us had both. So we came together, we bought a condo, and the bank allowed us to borrow some money at 17%. And that was normal back then. And, and I would also add that neither one of us had credit. I was just out of school. And my mother was deciding to go back to school. So, so we didn't have any credit. Thankfully, we could refinance over the years. But today, and David, correct me if I'm wrong, we've got interest rates that begin with 2s and 3s.
Yeah, that's correct.
So you guys are saving tons of money in your mortgage payment compared to my initial mortgage payments. I actually do have a slide here too that shows you that even within the last 2 years, relative to where interest rates have been, you can purchase almost $50,000 more worth of a home with today's interest rates. So now I will tell you, even though there is discussion of recession, current recession, housing prices are forecast to increase. And that is because this is not a housing crisis. This is not 2008, 2009. This is related to a world event or pandemic, largely. So the housing prices, people are hesitant, a little bit hesitant to put houses on the market right now, but there's still a significant demand. So what does that mean? It means that inventory is short, demand is high, and prices are going to continue to increase. So again, now is a good time to buy. We also right now have what we call an ideal housing affordability index. And so what is a housing affordability index? It is simply the mortgage payment as a percent of your income. So historically, the norm is right around 20%. That's kind of an ideal place to be. David will talk a little bit later about some ratios that banks take a look at that are a little bit higher than this, but ideally, on average, historically, the percentage of your mortgage payment as a percentage of your income is right around 20%. What this graph is showing, and this is really from the National Association of Realtors, is showing that in the last 2 years, so it starts kind of in June 2018 and goes through the end of 2019. So even then, David, what were interest rates at the end of 2019? Were they 3s and 4s back then?
Yeah, almost mid to high 4s in 19 at points. Rates have come down considerably.
Right. So the reason that's important is that this data is, at 15.5% of income. That was when interest rates were in the 4s. Again, we're now in the 2s and 3s. So affordability is even better. Okay. Black Knight is actually a provider of analytics for the banking industry. And so what I want you to cue into here on this slide is, it says, despite the average home price increasing by nearly $13,000, the monthly mortgage payment to buy that same house has dropped about 10%. So put another way, and this is where that, that tip I said earlier, that you can actually buy almost $50,000 worth of home today as compared to just 2 years ago. So again, it's a really great time to really take a look at what is listed out there and talk with an experienced realtor and an experienced mortgage lender to, about what you can afford. So the whole, should I continue renting or should I buy question. So one thing I always tell my new buyers, keep in mind that each time you pay rent, you're actually paying someone else's mortgage and you're building someone else's equity. So why do that? When we take a look at rental payments right now, they can be significantly greater than mortgage payments. So when you're buying, your monthly mortgage payment is actually building your equity and building your asset base. That's a good financial move. Again, renting, you've got, if you have the money for upfront security, first month's rent, last month's rent, and in some areas, the brokerage fee, which is typically 1 month's rent. If you've got 4 months rent, David, we talked about this earlier, if someone has 4 months rent in the bank and can go sign a lease, they could sign a mortgage that has little or no money down, right?
Right, yeah, anywhere from 3% to 0 down, which we'll talk about a little bit later.
Yeah, so if you've got the cash in hand, why wouldn't you do that? Now, renting does provide you some flexibility. If you're, kind of building your career, you have reasons to believe that you're going to relocate sometime soon, then there's the flexibility. You can just end your lease and go. Housing has, is a little bit more of a, kind of a commitment. However, I would suggest that if you're here 3 to 5 years, then in a particular location, then you may want to still buy. You'll have an asset, you'll be building an asset, and you might be using that as the start of your rental portfolio. So keep that in mind. Renting, you can move into an apartment and have little or no responsibility for maintenance. Buying a home, and I'll go through this in a further slide, you are responsible for the yard work, you're responsible for the home repairs, the new roof, that sort of thing. However, you might consider a condominium. So David, I think you're talking about this a little bit later, but a condominium gives you the benefit of being able to live in the home and not worry about snow removal, not worry about the grass, not worry about the roof. You're contributing toward a fund that may assist in those things for the building itself, but you're not solely responsible, and you've got a lot of flexibility. So again, I would talk to your realtor and talk to your lender about, perhaps there is a way to combine the best of both worlds. David, did you want to add anything here?
It's just funny, I was thinking about how long I've been in condominiums. We were talking the other day about the cost of replacing a roof, and you and I, neither you nor I have any idea how much it costs to replace a roof, which is kind of ironic. So we'll talk about the merits of condominium ownership versus single family. The nice thing as a condominium owner, you don't get hit with really big unforeseen expenses. But there's a trade-off. Your monthly payment to the mortgage company because of condo fees is higher. So we'll go into that a little bit later.
Yeah, and I think too, and again, this kind of is an opportunity for offline discussion with your realtor, but one of the things you do want to make certain is that there are no special assessments in a particular condominium. So there are some times when evaluating the financials of a condominium, you'll want someone to take a look at that with you, because if there have been a history of special assessments, you may be hit with a surprise. But there are ways to keep that from happening. So just this point, home ownership is truly a commitment. And how much of a commitment? what are the things that you need to keep in mind? So in addition to your monthly mortgage payment, I would ask you to think about the following. And again, whether it's your realtor or a contractor or plumber, electrician, people that you might work with, and certainly your realtor works with and can share with you, there are a number of things that you need to keep in mind. So for example, landscaping and gardening. If you want to increase that curb appeal, that's your cost. You might want to update your windows for energy efficiency. Wood siding also needs to be painted periodically and sometimes needs to be replaced. So taking that into account. Your home inspector during your purchase process will help you kind of put this list together as well. Doors, you might need a cosmetic or an energy efficient door. You might want to put a storm door on. Roofing and gutters, I'm just looking at a list here. Garage doors, there's a certain mechanical component of that. So every once in a while, someone might accidentally hit that door and you might have to repair it. So you've also got periodic driveway maintenance, and that's just the exterior. So not to scare you, you've got a team behind you when you have a good realtor. So, but it's these things keep in mind before you actually go to then. I think our next topic here is qualifying for a mortgage. David.
So thank you, Patty. So for people in the audience, I want to make sure that you're aware, I have no control over the screens. Patty holds my life in her hands now. So she's advancing the screens for me. So the first part of qualifying is what do lenders consider? In general, we look at income, current debts, assets, and we also look at the property. So as far as income, we ask you about what are your sources of income. So are you a salaried worker? Do you make money hourly? Do you just have income from a job, or do you make rental income on other properties? Are you self-employed? So the lender really should be asking about all of your sources of income. As far as current debts and credit history, we are going to pull a credit report, and we are going to see what your monthly obligations are. So it's important to understand that. And one thing that we look at is we look at how well are you paying your monthly obligations? Are you paying them within 30 days of the due date or not? And we also look at the mix of debt. What kind of debt do you have? We're going to go a little bit deeper into credit in another slide, but in general, you want to try to make sure that you have as much secured debt as possible, like mortgage money is secured against a house asset. That's actually good debt, and that gives you good credit points. Car loans are pretty good because they're secured against a car. Unsecured debt is not that great. Credit cards are not secured against any asset. They're, if you stop paying, the creditor loses out. So that's considered bad debt. We'll talk a little bit more about that later. As far as assets and available funds, the lender really is going to go into what do you have in your bank accounts? What do you have in your retirement? We're going to find out, are you thinking of assets for down payment that are not your own right now? So that could be gift funds from a parent or a relative. If you are going to use gift funds, it's important that you understand that money needs to come from a relative, not somebody who's not related to you. So that's something that the lender will go through. As far as property, we're going to be asking you in the pre-approval stage, we're going to ask you what kind of property are you considering. And then when you find a property, we're going to investigate in detail about that property as far as its value, condition. If it's a condominium like Patty talked about, we actually do go into how well managed the condominium community is. Is the condominium community budgeting the right way? And we do a lot with investigating insurance. We really make sure that the house or the condominium is insured to a proper level. Next slide, please. So how do lenders evaluate my ability to repay? This is the ratio part that Patty was alluding to before, where she was talking about the affordability index. On the right-hand side is the same equation that she was looking at, where lenders look at your income versus just your housing payment. So on her chart, it scaled from around 16, 17% down to 15%. Lenders are comfortable with 28% or less as far as your income versus your payment. So say you're making $10,000 a month, we want your housing payment to be no higher than about $2,800. In addition to just your housing payment, we're going to look at your total debts versus your income. So that's housing plus car payments or student loans or credit cards. So that's another ratio that we look at. You'll notice that that ratio is higher. That's because it's taking all of your monthly obligations together. We really want that to be no higher than 36%. So again, I'm using 10,000 because it's an easy one for me to do the math on. So I'm kind of cheating a little bit, but again, if you're making 10,000, if your total obligations, including housing, are 3,600 or less, then you're in great shape. The thing that's interesting is lenders do go as high as 45 to 50% as far as what we will qualify you for. Personally, I really like to help my buyers be more in this 28, 36% range, but some people have compensating factors. They might be self-employed where they make more income than the lender might be able to use to qualify. Married people, very often, they might want to qualify with just the husband or wife's income. So the compensating factor there is that the lender realizes that there's much more household income than just one person. So that's why we will consider ratios that are higher than these. So that's just something to be aware of. Next
so
slide,
David,
please.
before you move on, since I have control over the slides, but I was going to say, is that, so I'm going to be a little bit of the budget coach here. And so I often will share with my buyers that, that my lenders used to say, oh, you can afford a house of this much money. And I remember thinking, wow, that's a lot of house. And then I would look at my personal budget and say, still want to go on vacation, still want to go out to eat, still have to save for, for college education. So again, I think that, as you're looking at these ratios and as you're talking with David about, how much is it, can I afford? Take those numbers and then put it into your household budget. Because you also, not only have your mortgage payment, you've got those household maintenance and repair items, but you also perhaps have a broader life in things that you like to do. So.
Right. I noticed that JP has a question, but just real quick, just to wrap this part up. For my younger buyers, I often ask, how much are you paying in rent? And normal rent for a younger person is $750 to $1,500. And then we go into the analysis of how much the lender will let them go up to, and sometimes it's $3,000. So $750 a month, $1,500 versus $3,000. That's a monumental change. So I usually try to put it into perspective to think of how much are you paying for housing now versus, what could it be? JP, did you have a question?
Yeah, just a quick question. When we're talking about monthly housing payments and you're capping those to 28% or less, unless there are extenuating circumstances, are property taxes and other things built into that monthly housing payment, or is that an addition?
Yeah, that's a wonderful question. For single family houses, it includes principal, interest, property taxes, and homeowners insurance. For condominiums, that includes the condo fee. So it's principal, interest, property taxes, insurance, and condo fee. It's more difficult to qualify for a condominium because the payment that the lender is using in the equation is higher. But again, that's where it's nice to have the compensating factor to go to 45 or 50%. That really helps the condominium approvals. I haven't come across many buyers that, if they're being realistic about their pricing and budget, they do get qualified for condominiums. It's not very difficult. So thank you for the question, JP.
Thank you.
So credit basics, we touched on this a little bit. Now we're going to go a little bit deeper. The range of scores out there is anywhere from 300 to 850. As far as general consumers these days, raise your hand if you're barraged right now with free credit scores from your bank and your credit card. Every day I'm getting Credit Karma. It's a little bit, it's very hard to be a lender because the free credit score range tends to go off of different equations than what mortgage lenders use. Mortgage lenders are very, very conservative. The score that we use, the FICO system that we look at, it's been around for tens of 20 to 30 years or longer. These new scores that are coming out with the credit card companies, it's a little bit of a new system, so the range is different. So make sure as a consumer that you don't go by what you're getting for the free score. More than likely, that's going to be different than what the lender has. Especially if you're younger, unfortunately, one of the first bullets here is payment track record and length of credit history. When you're younger, your score is going to be very volatile. It's going to go up and down quite a bit. And the reason for that is you don't have a lot of credit, so every little thing is going to play into your score, and it's going to wreak havoc and make it go up and down.
Excuse me for a moment, David. I think Macarena, you have a question?
Yes, I do. I wanted to ask you if the history of your previous purchases of homes that are not in the US, would that count toward your credit in this country or not?
Yeah, that's a really wonderful question. Luckily in this area, I have a lot of non-US citizen customers, people who are new here to the country, and Wells Fargo and most lenders, we do allow for a manual building of your credit score. So if your credit is only non-US and it doesn't come up in the normal US FICO system, as long as you provide documentation and contact information for the creditor, lenders will be able to contact your creditors overseas and will be able to build a manual score. What we'll do is we'll ask for your track record manually, and we'll pull it in, and it'll become part of your electronic US score. So wonderful. Does that answer your question, Macarena?
Yes, thanks a lot.
Okay, wonderful. So as far as the score is concerned, payment track record, amount owed, an amount owed is more amount on unsecured debt like we talked about. A great example of this is, again, I'm going to use my 10,000 again. I'm cheating again. It's an easy number. Say you have a credit limit of 10,000 on your credit card and you're charged at 9,000. That's going to give you really bad credit points. In general, you never want to charge more than 25% of your credit limit. And that'll give you really good credit points if you stay below the 25. So don't charge more than 2,500 on 10,000. Many people, younger people might have a very small credit limit, like 500. And with a $500 credit limit, it's really easy to accidentally charge up a $600,000 item. The credit card company is very happy to let you extend above the limit because they're going to force you to pay that down quickly. That's going to give you terrible points. If you're above your credit limit, that's going to hurt. The wonderful, wonderful news, though, is that's easily fixed. It's not a long-term problem. The second that you pay down that account and the next statement comes out on your bill, that gets reported to the bureaus and instantly your score will be lower. So that's the reason why for some people with not a lot of history, or if they have debt that they can change on a regular basis, their scores are going to go all over the place. But the wonderful news is it's easy to fix and easy to get great credit very fast.
David, can you comment on student loans? Because I know that a number of my first-time home buyers, particularly my younger buyers, come in with a lot of student debt. So can you comment on that?
Yeah, student loans are somewhat neutral. They're not secured. So they should count as bad debt. But luckily, the FICO system understands student debt, which is somewhat responsible. You're putting debt against your future. So as far as credit scoring, it's not good or not bad. It's kind of neutral.
Great. I think I heard a few sighs of relief.
So how can I improve my credit score? We kind of talked about this as far as paying down revolving debt. One thing to consider is automating your payments. What a lot of people don't realize, though, is that can be a very dangerous thing. The FICO system has no tolerance for ever missing a payment. So if you set up auto pay, and if the funding source doesn't have any money and the bill doesn't get paid, you are still responsible for having missed that payment. So set up auto pay. It's a great idea, but still monitor and make sure your payments are getting paid. Don't open a lot of new accounts. The rule of thumb is never have more than 3 unsecured credit card accounts under your name, and try not to open a whole bunch of accounts all at once. The other thing that I love that is stated here is don't fall into the bad dog syndrome. If something's going wrong, don't turn away and hope that nobody sees you. If there's any trouble whatsoever, the creditor wants to work with you. They want to make an arrangement. It's far, far better on your credit to contact the creditor the second that you're having any trouble and iron out some sort of plan. Your FICO score is going to show if you're planned and working through it versus ignoring the debt. So next slide, please. So home financing basics is our next section. This section here talks about down payment. This chart is supposed to be showing a smaller down payment versus a larger down payment. In general, with a small down payment, you're going to end up paying more interest over time. But there's trade-offs in this. So say you're looking at a $400,000 house and you have $100,000 in the bank. So logic would tell you I should put that entire $100,000 down payment down on that property. The only problem is, what does that do with your reserves, your rainy day fund? Does that cause you cash flow issues? The other thing that people don't realize is once you pay your down payment, that money's kind of gone. It's paid into the account, and it's very hard to get it back. The only way that you can get it back is to borrow more money against the house, which sometimes can be hard to do. So when you're considering down payment, make sure that you think about reserves. A great rule of thumb would be 6 months of your overall total monthly expenses. So that's that total ratio that we talked about. That's a great starting point. Smaller down payments in today's market, the past 20 years, lenders have really worked to come up with great options for small down payment. Veterans Affairs allows for as little as 0% down. Locally in this area, out in the Acton market, in towns like Westford, and west of that, there's a rural guarantee program that it is limited. You can't make too much income to qualify for rural guarantee, but that's 0% down with a family income of up to $130,000. So that's an awful lot of family income for people to be allowed to get 0% down. A lot of people think that low down payment means higher interest rates, maybe points, maybe PMI, which I'll explain in a second. But in today's market, lenders have done a great job of keeping the rates reasonable, not charging a lot of PMI, and helping you with a small down payment. So PMI basically is insurance for the lender against default. So what we've noticed as lenders is when people do less than 20% down payment, the risk of them not paying back their mortgage is higher than if they pay 20% down or more. Because of that, lenders have gone out and we purchase insurance to pay us in case somebody doesn't pay back their mortgage. That insurance premium is passed on to the consumer, it's passed on to the buyer. And that's what PMI is. So if you do put less than 20% down, you will have to pay that insurance premium. In general, it's on a $400,000 property, it can range anywhere from $30 to $80 a month onto your payment. It used to be something that you were required to pay for at least 2 years, most times 3 years. Most lenders have gone to where there's no waiting period to get rid of PMI. So that's wonderful news. So we're really working hard to help people get into property with very little money down.
So
Next slide.
David, I've been told that there are some mortgage programs that require as little as having paid 15% as opposed to 20% down. Can you comment on that?
So there is something called lender paid PMI. It gets a little bit confusing. Lenders can charge a slightly higher rate, and the lender will pay the PMI premium.
Okay.
When you're doing 3% down, it might be 0.5%, maybe 0.6% higher rate. If you're doing 15% down, you're so close to the 20% mark. Sometimes it might not cost the lender anything. So sometimes I'm able to charge the same exact rate and have the lender pay the PMI. So definitely talk to your lender. And if you're thinking of 5% versus 15%, have your lender run the scenario. You might be pleasantly surprised. So that's a good question.
Great. Good. JP,
Yes,
you have a
JP.
question?
Okay, one quick question. I understand the concept of the risk being reduced by the buyer making a larger down payment. Skin in the game.
Mhm.
It reduces the amount of exposure to the bank. It reduces the amount of interest payment. However, how does the age of the buyer impact that equation? Because in the end, you may find a situation where the buyer, actuarially speaking, perhaps even has less time projected than the length of the sought after mortgage. How do you work with that, and how does that impact the pricing?
Yeah, I'm very happy we're recording this from a compliance standpoint. I'm very happy to tell you lenders do not consider age in our rate and pricing. So that's not part of our consideration.
So I think where it might show up, JP, is in the length of credit history.
Right.
You know, so
Longer in the tooth, more history, and that's a good thing. This is very different from the European system, where the loan is a personal loan rather than fully secured with the asset that's backing it. So this is a refreshing change.
Yes.
Yeah, well, I have bad news though. I mean, we'll get into it in a few more slides. The equations that we use in our process, it's really investigative. So we do cover our risk in many other ways. Age is not one.
Sure.
Yep.
Thanks.
The next slide. So do I need 20% down? We've kind of covered this, so you can skip to the next one.
Great.
How can I save? I love this slide. The greatest thing in the world that you can do is pay yourself first. That may sound really confusing. What that means is, say my $10,000 number comes in, this Friday, this week. What I should do is I should have an amount of money that I'm going to transfer from my checking account that the pay comes into to a savings account and not touch it. That's my do not touch pile. So the 10,000 comes in. I make a deal with myself that I'm going to put 2,500 into my savings account every single time the paycheck comes in, and I don't touch that money, or I invest it and have that grow. That's what pay yourself first is. Now, pay yourself first only works as well as budgeting. So if I owe $8,000 a month and I haven't even started the month and I put 2,500 aside, I've already blown my budget. That's not realistic. There's no way that's going to work. So make sure that you're budgeting, be very aware of your expenses. The thing that's great about Pay Yourself First is at the end of the period before the next paycheck, you're going to see, did I spend too much over 2 weeks? And now I'm very short on funds. So the Pay Yourself First is a great way to get prepared for buying a home. It's a great way to save money. It's a really wonderful trick. The other thing that this says here is spend less, save more. Again, wild concept. But if you're not keeping track, you're not really going to know. So track it and try to spend less. So next slide, please. So what loan options are available? We've talked about some of these. There's fixed rate options. What that means is the rate will never change. JP brought up, are there other components of your mortgage payment? Fixed rate mortgages do not fix the fact that property taxes and insurance and condo fees can change. But at least if your mortgage rate is fixed, then the other changes are going to be nominal, maybe $30 to $50 a month here and there, versus if your rate was adjusting, that can be a larger swing, $200 to $300 a month, depending on the adjustment. That being said, the next thing here is adjustable rate mortgages. The way I described it, those sound really, really bad. But adjustable rate mortgages can be wonderful if you know your time frame of ownership of a property. So adjustable rates can be fixed for the first 3, 5, 7, or 10 years. If you're a high-tech contractor and you know that your contract is expiring in 3 years and you have to move to Europe, a 5-year adjustable is a wonderful vehicle. It guards any risk of adjustment, and you can enjoy a low payment during that fixed period. Adjustable rate mortgages typically have a lower rate for their fixed period than fixed rate mortgages. So today, a 30-year fixed rate might be around 3.25%, versus a 7-year adjustable. I just sold one earlier today that was 2.5%. So big difference.
Well, and David, I would just make, there's a lot of statistics from the National Association of Realtors, for example, that will suggest that people only live in their homes for 7 to 10 years on average. And even, I have this conversation with my buyers all the time that, they believe they are buying their forever home. And I purchased my forever home 5 times. So what I learned in hindsight, and really even talking with you, is that a 10-year ARM, adjustable rate mortgage, may have been my best bet, at least 4 of those times.
Right. Yeah, so those are important considerations. FHA loans are up here. I'm not going to go too deep into those. FHA back about 5 years ago was a wonderful, wonderful product, maybe 10 years ago now. FHA was built around low down payment with tougher qualification issues like softer credit, maybe not a lot of reserve funds, maybe instability in your job. That used to be what FHA loans were great for. There's been a lot of default with FHA loans, especially during the mortgage crisis. So the money from FHA comes from HUD, which is government backed, and they've had a lot of budget problems. So FHA nowadays is very, very expensive. Luckily, lenders have come up with alternatives on the conventional loan side. So make sure you're talking to your lender about the differences between FHA and conventional if you need a low down payment, 0, 3, or 5%. VA loans are terrific. VA loans have no PMI. They're government backed, but totally different pool of money. These loans are for veterans, people who have been in the armed services. So 0 down payment, no PMI, and loans up to 1.5 million. The 0 down payment is only up to about 500,000, but even above the 500,000, you don't need to do 20% down all the way up to very high loan amounts. So if you are a veteran, make sure to look into this option. It tends to be a wonderful program. Jumbo loans in around the country, they tend to start at $510,400. The jumbo loan is basically a risk calculation. In general, the risk of default when you borrow higher than $510,400 is higher. So jumbo loans tend to come with different criteria to mitigate the risk and make sure that you can pay back that loan. Here in Middlesex County and also Essex County locally, the jumbo loan limit is $690,000 or higher. The importance about these limits is the rates and qualifications are totally different. In general, if you borrow less than the $510,400 or less than $690 in Middlesex County, in general, it's much easier to qualify for. You only have to put 5% down for loans below those limits. If you try to borrow above those limits, usually you're required to put 10 to 20% down, and you have to have at least a year in reserve funds to qualify. The next section is loans for newly built homes. The important thing to know about loans for newly built homes is if you're purchasing a home from a builder and the builder has paid the money to build the property, you're basically getting a regular conventional or jumbo loan from a lender. It works the same exact way as any existing property. There's nothing very tricky if you're purchasing the new property from a builder. If you want to go out and purchase your own land, and if you want to pay the builder to build the house, that's much more risky. That's where the lender is securing their money against a asset that's truly not built yet. Typically, that scenario requires 25% down, and it's very hard to get a fixed rate in that scenario, and you're typically going to pay extra lender fees. So those are the differences. Next slide, please.
Actually, just before we go, a couple things that we talked about earlier, David, with regard to the jumbo loans. And so the limits can be different from one county to another. So I have had buyers initially looking in Middlesex County and then looking in Worcester County. And so Worcester County is different from Middlesex County. So always when you're going from one county to another county, and our counties are, there are a variety around here that people can still commute at a reasonable distance from, make sure that you mention to your lender that you're talking about, you're looking at homes in a different county than when you started. I also just wanted to make the point we've got a number of new housing developments in our overall region, and most of those are in fact homes that the builder is building with his investment money, and so it is a conventional loan. So as David was sharing, it's when you want to go out and do it yourself, buy the land and then hire a builder, when it gets a little bit more risky. But if you're looking at new construction and someone else is building the neighborhood, it's a slightly different offer process, but it is a very similar loan process.
All right, so how do I know how much I can borrow? So this presents pre-qualification versus pre-approval. The first thing that you should know as a buyer is do the pre-qualification, pre-approval analysis first before you go look at property. Having a lender take a look over your qualifications, it's going to help you a ton with your housing budget, how much house you can buy, and whether or not you're going to qualify for that mortgage. The pre-qualification versus the pre-approval is basically a level of analysis by the lender. Some lenders, they may be a little bit hurried. They may not want to look at your credit. They may not want to look at your documents, your income, your assets. They may not ask a lot of questions, and they may just give you a letter right off of their shelf. That's far different than a pre-approval. A pre-approval is where the lender formally applies for financing. Typically, it doesn't come with any cost, but it comes with quite a bit of process and analysis. So the pre-approval is where we pull credit. We look at your taxes, your W-2s, your pay stubs. We look through your bank statements. We ask you a lot of questions about your source of down payment. For myself, over the years that I've been lending, I would have to say about 40% of the time, I ask people, how much money do you want to put down? And, it might be $100,000. And then I'll gather their bank statements that afternoon, and they might only have $15,000 in the bank. So thank God we did that pre-approval, because I call them up and say, what's going on here? And that's when we get into, oh, my parents are giving me a $100,000 gift. So it's important to have a deep level of analysis of process up front. In real time, it should be no longer than a half a day to a day and a half, maybe 2 days at the most. But it's time very, very well spent. There's nothing more embarrassing, and Patty can tell us about this in a second, than driving around, finding your dream house, going through the process, putting the $1,000 deposit or reservation down, and 3 weeks later finding out, oh my God, I can't afford this and I can't get approved. Patty, have you ever seen that scenario?
Well, not so much recently, because nowadays sellers are pretty savvy. And what they will do is they will require, many times even as we're making the showing appointment, require that someone has that pre-approval letter. So they, many sellers want serious buyers to come take a look at their homes. When the offer is presented, absolutely, there needs to be a pre-approval letter. And a good seller's agent, this is what I do when I represent sellers, I actually call the lender and find out, so how detailed was that analysis? Because if it's just a pre-qualification and there are multiple offers, someone who's might be just be putting 10% down as opposed to someone might be putting 30% down. If someone just has a pre-qualification, another one has a really good, strong pre-approval letter, you know what? The seller might feel safer taking that one with the pre-approval letter. So it really, it's not only about price always, although that certainly helps, but it's not always about price, but it's about the strength of the other terms that you're proposing in your offer and the strength of your pre-approval letter. So it really does pay off. Many times when I do my buyer consultation, I say the first thing you should do, you're talking to me, we're talking about houses, we're talking about what we'd like to go visit. However, my preference is to be having those conversations after they've had a conversation with someone like you, David. Ready for the next slide?
Yes, please. Thank you.
Okay.
All right, home financing process. We've gone into some of this already, but in general, you want to make sure that you complete your application prior to the property review. And then you'll be preparing for closing and you'll attend your closing. Preparing for closing is a very, very important step these days. A lot of people, as they go through the process, they're not sure that their closing date might be fast approaching, but they might not be sure that they're fully qualified and fully approved yet. So make sure that as a buyer, you're very, very involved. You're asking questions of your lender, of your realtor, and make sure that you're truly prepared for closing. When you're closing on a new property, you're typically getting ready with moving vans, paying for utilities to be hooked up, buying insurance. Those are pretty final things. It's very hard to reschedule your moving van. So be very involved in the process, make sure you're on target with your dates, and make sure that everything is going fine. And then after you go through this big process and all this analysis, you have the really fun part of attending your closing. Back when I purchased my first house, myself and the seller and all the attorneys and realtors and everybody got together in a room. Patty, what are closings like today?
Well, it's interesting, they go from having what we call a drive-by closing, which effectively is the buyer comes in their car, signs pieces of paper and drops it off. Sellers don't need to attend closings. Many times they can sign a power of attorney to their real estate attorneys, so that real estate attorney signs all the papers, and many times that attorney overnights the paperwork. So typically today it is the buyer attorney and the buyer.
Excellent. So next slide, please. All right. So what should I do during the loan process? I really want to call this, what should I not do during the loan process? Things like, going out and having crazy expenses, not paying attention. Those can really derail the process. One thing that you should definitely do, though, is provide accurate information. You really want to think of the mortgage person and your realtor as your coaches. You want to really tell them the truth about your situation. You'd be amazed at what we can do as long as we know the full situation. It's actually an awful lot easier to qualify for a mortgage and buy a house than you might think. So definitely don't keep anything under the rug. Full disclosure at all times, and just stay prompt, stay paying attention. The last thing that I'll talk about here is homeowners insurance. Most of my buyers save the insurance investigation for last. I really encourage you to do that as one of your first things. Contact agents right away. You can pay for and set up your insurance weeks and weeks in advance of closing. The insurance does not become active until your closing date, so you're not wasting money by establishing insurance up front. Next slide, please. Oh, so.
So David, we're all set. So before we conclude, we'll talk a little bit about these resources, but are there any questions that we have missed or any pieces of information additional information we can provide anyone? Christine, do we have any questions in the chat box?
We do not, Patty, right now.
Great. Well, thank you for coming. Here are the different resources that certainly. JP, you have a question?
I'm going to ruin a perfect straight. Sorry. Yeah, I've got a question. It's a two-pronged question for both of you, Patty and David. I guess the first part, when buying a property and thinking that maybe the horizon, maybe the time horizon, you want to flip it, you want to sell it within 5 years, within 7 years. You have a reason why you want to buy the property, live in the property, sell it at some point, and be able to sell it quickly.
Mm-hmm.
So waterfront property, whether it's pond, lake, ocean, liquidity in the economic sense, is that our properties that are on the water more readily sold? And then for David, how do you view that from a risk assessment standpoint and mitigating the obvious risks, flooding and whatnot, due to proximity of water? How does that work?
Well, I'll start by saying that yes, properties on the water tend to carry a higher price tag. So I currently have a waterfront property that we're marketing, and I'm getting a lot of interest and a lot of questions. And my expectation is that the price will be bid up a little bit because my strategy is always to price at or slightly below market in anticipation of the market bidding that price up. So, and in this particular area, there are very few properties that are on the water. So, lower number of houses available, greater demand, higher price. Okay. One thing, David, you are probably thinking about mentioning this, but from a home insurance perspective, that's another reason why you want to do it right up front, is to identify, is it in a flood zone? So if you've got a waterfront property, but it's up on a hill, you might be fine. So David, did you have stuff to add there?
Yeah, again, good news, JP. We analyze mainly your ability to pay back the debt. So we're not very concerned with geography as far as the property. Because waterfront properties tend to have a higher value, it is nice that they might have more equity in those properties, but it's not necessarily a huge part of our analysis. As far as flooding, that is very, very important to us. Lenders have really, really strict guidelines. We are required, we actually do a satellite scan of every single property just before you close. We check the flood maps that are on record, but we also do our own satellite analysis to find out, is that property in danger of flooding? If there's even a remote danger, you are required to purchase flood insurance. Very often I have people that complain, they're very unhappy about the expense, but I remind them of the expense of the danger of losing your property. So as long as the aesthetic, the reason for buying is there, flood insurance is a great thing. It is expensive, it's not fun, but at least you won't lose your house to a flood and lose all your money. So that's essentially what we look at.
Great. Thank you very much.
You're welcome. Any other questions? I think we're good. So thank you, David. We've got a number of resources here, and you don't need to scribble down, and take a lot of notes. If you did register, we have your email address, and we did that on purpose so that you can, we can send a PDF of this presentation to you. So you'll see all of these resources, the banking resources, they're all related to David. I can help you with that home search. We asked if there were any questions. I think we are all set. One more chance.
Macarena had her hand up first.
Oh. No, I think she was clapping.
Oh, that was a clap? Okay. I thought that was a hand raise.
So thank you, Macarena. I appreciate that.
I'm still super new to this Zoom thing.
Yeah, so you are welcome to contact either one of us. Again, my preference is if we're going to go out and look at some houses and get serious, then my preference is that you speak with someone like David first. I can usher you into David's office if you'd like, but just really exploring what can you spend and knowing what you can spend with confidence. And then I'll scare you a little bit with budget and that sort of thing. So I am a budget coach from that perspective. Now, a question for you who have joined us. So David and I would like to do this more often. This was a very kind of high level conversation about why you would want to be a buyer today. And it's absolutely a great time to be a buyer, and how you would do that and how do you get ready. But are there other topics that you would like us to address in a future seminar? JP?
First of all, thank you for this, because this was a fantastic quick dive into what is a very different market from what we've been buying and selling in over the last 20 years, which is the European markets. But what about buying property in the aim of renting it as a source of income? That would be an interesting kind of how do you focus that from a financial standpoint? How does that affect, Patty, your recommendations in terms of what to look for, what sorts of properties, what type of coverage, and where you have a higher chance of that being a good, solid investment from a financial standpoint?
Well, go ahead, David.
I'm also wondering from the group if we can get feedback. Are people interested in older housing, and how can I maximize my wealth and property value by investing in renovation? Is it possible to overbuild and lose my money? Should I be careful about renovation? So I'm wondering if people might want to hear more about that kind of thing.
Yeah, remodel, and there are renovation loans and remodeling loans.
Yes, that would be something that I would be very interested in.
Good.
I thought, Jay, I thought you had a husband who could fix everything, though. You don't need any remodeling.
You might be referring to my husband. Who knows? Okie doke. Well, good. Again, I want to thank you for those topics, because I think they're great topics. I have a variety of ways that I've assisted couples in buying small and then renting and moving up. So initiating their rental portfolio that way. Or I've helped a number of investors purchase in neighborhoods very similar to a number of the condo neighborhoods, for example. They do allow a certain percentage of the neighborhood to rent. So that is also an opportunity there. And then older homes, lots of those in New England. So great. Again, thank you very much. Whoops, there we go. That's the end of it, but I was going to put up our contact information. Again, when you registered, you gave us your email address, and we will follow up with you with a PDF of this presentation. And you are welcome to contact us with any questions and any suggested topics for future seminars. So thanks very much.
Thank you very much.
You're welcome. Our pleasure.
It's not hand raised. No more questions.
Okay. Great. So with that, I am going to sign off. And
Patty, once you sign off, you will be ending the seminar.
okay, great. And that will record, and the recording as well.
That's correct.
Okay. Thank you, everyone.